What's going on, everybody? It's going to be another one of our recaps, but I'm going to do things a little bit differently in this recap. So normally we have been picking a day that had some really good setups, and we have been recapping the best trades from that day. But what I wanted to do in this recap is go back over basically all of last week, Monday through Friday, because I wanted to go over how you can normally treat these FOMC weeks. Because last week, if you guys remember, we had FOMC on Wednesday. So normally the first thing that you want to do when you have an FOMC week coming up, this can be for the standard FOMC weeks or the FOMC weeks that are minutes. They're not the actual meeting. You want to mark out the weekly open. So normally we do this on a futures chart with the extended hours turned on, obviously. And the weekly open is typically the Sunday open because technically that is when it opens. It's not the 9:30 open on that Monday. It's actually the prior day at 6 p.m. So if you mark out the open on Sunday, that will give you the most accurate weekly open you can pull. And the other thing you want to do on FOMC weeks is you want to look for the first 5 minutes when the FOMC actually comes out. And we're going to go back over these levels and how to use them, but I'm just talking about how to mark them out for now. So let me find the FOMC here. I believe it should be right here on Wednesday the 28th. So the first 5 minutes that we like to mark out, if you guys know, the FOMC comes out at 2 p.m. Eastern. So it's from 2 p.m. Eastern to 2:05. And we want to go ahead and mark out the low during that 5-minute candle and the high during that 5-minute candle. Okay, before we go over how to use that, let's go back over the weekly open really quickly. So why do we like to mark out the weekly open on these FOMC weeks? They typically act like magnets. Think about like a POC node on a day. It's a very high volume, high value node that acts like a magnet and constantly pulls price back into it if it tries to push away. You try to find higher value, pulls back down. You try to find lower value, it pulls back up. And you kind of hang out around that POC. Well, that's basically what you're looking at with the weekly open magnet on an FOMC week. You typically want that level to act like a magnet during that week. Most of the time, the magnet will be a lot stronger on Monday and Tuesday before the FOMC. Last week, we had a little bit of one of those weird scenarios where the magnet was stronger going into the close of the week. And that was mostly because the magnet did not work early on in the week. So typically when you see price moving very one-directionally away from this weekly open, let's say on Monday, we open up right here on Monday. This is our weekly open. So we are already pretty far away from that level. So as we are pushing farther and farther away from that weekly open, unless there is something very obviously driving this price, like some kind of data or major earnings or just something, some kind of catalyst that is very heavily driving this price away from that weekly open, you really don't want to trust it too much going into the FOMC or going into the end of the week. So Monday and Tuesday leading into the FOMC, we really want to see that price action hanging out around that weekly open. So if it pushes heavily away from it to the upside, we want to see a pullback. If it goes to the downside, we want to see a pullback, right? We want to see price relatively close to that weekly open. And then when the FOMC finally comes out on that Wednesday, that's where that directional bias can start to come from. So then you can start pushing aggressively away from the weekly open, and you don't have to rely too heavily on it on acting like a magnet on Thursday or Friday. In this type of scenario, where it's ignoring the weekly open at the start of the week, then we do want to rely on it acting more like a magnet into the end of the week, into that Thursday and Friday. And that's exactly what happened during last week. It pushed very aggressively away from the weekly open. Then the FOMC came out. It didn't really respect that 5-minute range, which we'll talk about here in a little bit. Tried to find higher value above that range. Could not do it. Re-lost it and then just nuked. And then look at where it bounced. It bounced right off that weekly open, damn near to the exact level. And then on Friday, we kind of just chopped around and didn't really go anywhere. So it was kind of acting like a magnet on Friday. You can see it was pulling price back down every time you tried to push away from it, but it didn't close like exactly on that level. So just to recap, during the FOMC weeks or the FOMC minutes, which is not an exact meeting, but it still kind of acts like the magnet on the weekly open. We want to mark out that weekly open, take the Sunday open, not the Monday morning. That typically gives you the best level. And if you are running very aggressively on Monday and Tuesday, you typically don't want to trust that price action too much, and you want to see it start to pull back towards that weekly open. If it is running very aggressively on Monday and Tuesday and it hasn't seen a pullback, then if the FOMC is not very aggressive, if it's not very one-sided, you do want to see that pullback into the weekly open on Thursday or Friday. If you are basically glued to the weekly open on Monday and Tuesday, and then you have a very one-directional FOMC on Wednesday, that is okay. It doesn't have to pull back into that weekly open. You're basically letting the FOMC decide if it has good value or not. Okay. Now, the other thing, that's more of a swing trading kind of strategy, something to keep in mind for your overall bias on your trade plan for these days, but you're not going to get like any tiny little scalps off of that weekly open strategy. It's more so just helping you determine your bias. But for more of the scalping sense, more of the day trading sense, that technique that you can use is that 5-minute strategy on the FOMC day. When the FOMC data comes out at 2 p.m. Eastern, it comes out at 2 p.m. Eastern pretty much every single time, you see that massive explosion in volume and delta typically on that 2 p.m. release. Then you mark out then you wait for the 5-minute candle to close. Then you mark out the high of that 5-minute candle and the low of that 5-minute candle. And you basically treat it like you would a value area. So if you're inside of that range, you are just looking for rotations, as we saw on Wednesday. It rotated that day multiple times. Or sorry, not that day. It rotated that range multiple times. If you are aggressively one-directional and you are building value above or below that 5-minute range, then obviously try to stay in that same direction of where that value is. And then every time you start to pull back into that range, like we did here, like we did here, here as well. I can hide the volume profile if it's a little confusing. Every time you pull back into that range, once again, you treat it like a value area. So you look for that retrace of that FOMC value. Very often, you will see when you retrace one side of it, it likes to go to the other side, the same way you would with a D-shape value area and a volume profile. Okay, so that's where you can get your scalps on an FOMC day with that range. And that's not only for that day, for that Wednesday. If you are still glued to that range on Thursday and Friday, which we kind of were on that last week, but not really, you can also use it for that Thursday and Friday as well. So same thing here, retraced it. You could look for that full retrace. Then obviously that weekly open came into play. And then same thing on the upside. It tried to retrace back into it, but look at that sell pressure coming in. Look at those massive wicks coming in on that FOMC. That time they were not allowing it to retrace back into the FOMC high. You basically are just treating this as a massive volume area, an influx area, because that is where the massive amount of volume and delta came in during that FOMC. Okay. So basically think of it as like a very strong volume node. If we were coming back to retest that node and you saw nasty wicks like that, and you saw a bit of a roll over top putting in a lower high, that's a pretty good sell signal. And that's exactly what happened. You sold off of that FOMC back down. Same thing here. Tried to retest the FOMC range again on Friday morning. And then did not find any value inside that range. Like I said earlier, treat it like a volume node. So you're kind of running into that node, putting in lower highs, sweeps, and then nuking. Okay. And you can do this for literally every single FOMC week. We have been doing this on stream for years, and this pattern has been the same. You mark out the 5-minute range of the FOMC, you mark out the weekly open, you keep those levels in mind, and it can give you a lot of trades during these FOMC weeks. Okay, so keep that in mind for your trading. The weekly open magnet strategy is not something you can do every single week. Some people like to watch it on normal weeks, but you can't really look for a weekly open to be a magnet on every single week because then the market wouldn't go anywhere, right? So I would only keep an eye on that on FOMC weeks and maybe those weeks around like triple witching, quad witching, stuff like that, where you have those massive expirations. Okay. But for the most part on stream, we are mostly just using this on FOMC weeks. But all right, guys, I hope you enjoyed this recap. If you did, hit that like button. Be sure to subscribe, and I'll see you guys in the next one. Peace.